Public account finished the day up $25,000. Not a bad move. Now everyone's trying to figure out the same thing. Are we officially back in risk-on mode, or is this just another fake bounce? Last week, the problem areas were obvious. Ethereum, Bitcoin, silver, those were getting hit hard. This week, they all bounced aggressively. Bitcoin tagged 60K and then shot up like it was fired out of a cannon. The real question isn't whether we bounced. We did. The question is whether this move has legs, or if this is temporary relief before another leg down. And while everyone's focused on crypto and metals, look at the 10-year yield. That thing refuses to budge, still hanging around 4.2%. Stubborn. That matters a lot. Mortgage rates don't meaningfully fall unless that 10-year drops into the 3% range. The government can talk all it wants about improving housing affordability, but until yields break lower, it's going to stay tight. In today's video, I'm covering 5 things. My 3 favorite high-yield savings accounts, how I would grade earnings season at the halfway mark, a stock I sold today, and why. 3 stocks I bought and the logic behind them. And finally, him talk. Not that brutal collapse and whether it's investable right now. Before we jump in, I need one thing from you. If you're getting value here, hit that like button. I'm fighting through being sick. Low fever, body aches, even my scalp hurts when I run my hand through my hair. My body's clearly battling something, but I'm still here showing up. I appreciate every single one of you who watches and subscribes. Also, quick heads up, Valentine's Day sale is coming Saturday. Gold tier Patreon, normally $145 a month, will be $49 for 24 hours only. That includes weekly buy-sell alerts, Discord access, and the full stock market master course. We send emails and texts at 6 a.m. Pacific on Saturday. If you're interested, it'll be in the pinned comment. All right, my 3 favorite savings accounts. First, let me address something I always get asked. Why not CDs? Why not treasuries? Because I don't want my money locked up. Period. I don't want penalties. I don't want restrictions. I want liquidity. I want cash that earns solid yield but can be deployed instantly. Markets move fast. NASDAQ could drop 5% in a week. It could drop 7% tomorrow. When you're a stock picker, you need dry powder ready. That's why I prefer high yield savings accounts. 1. SoFi. They offer 3.3%. and up to 4% if you set up direct deposit. No account fees, no minimums, up to $300 bonus. If you're willing to use direct deposit, it's solid. If not, you'll still get the base yield. 2. Ally been with them for 7 to 8 years, also around 3.3%. No minimums, no maintenance fees. They don't push direct deposit the way SoFi does. Reliable, straightforward. 3. Marcus by Goldman Sachs. This one's underrated, around 3.65% yield plus up to $2,500 bonus depending on deposit size. For example, $50,000 can earn you a $750 bonus, but you need to keep funds there for 90 days. Now here's the trade-off. If markets crash in those 90 days and opportunity shows up, I don't care about $750. I care about deploying capital into discounted assets. That's always the balance. For context, I've got roughly $479,000 parked in Marcus right now. Rate is legit. Could smaller regional banks offer slightly higher yields? Maybe, but I don't mess around with sketchy institutions just for a few extra basis points. Cash needs to be safe and liquid. Grading earnings season, halftime report. We're about halfway through earnings. Inside my private group, I grade every income statement. It forces discipline. Here's how things shook out. Amazon, a Elf, a Google, a AMD, A+, Apple, a SoFi, A+, Palantir, A++, only one I've ever given. Microsoft, A+, on the weaker side. Starbucks, D+. Tesla, D. Meta, C. Chipotle, C. Meta surprised me. Revenue growth was fine. Costs exploded. R&D spending is soaring across big tech. Here's the reality. AI is expensive. If companies are spending $200 billion on infrastructure and depreciating chips over 5 years, that's $40 billion per year in expense. And that stacks year after year. Margins will feel that. 76% of companies beat EPS estimates, roughly normal. But 73% beat revenue, that's above both 5-year and 10-year averages. Overall, strong season. But here's the warning. Earnings per share could be pressured for 2 to 5 years at big tech because of AI spending. Long-term, AI could be massively beneficial. Short term, it's margin compression. Investors may start focusing more on operating cash flow and free cash flow instead of EPS. And free cash flow is going to look ugly for some of these names. Stock I sold, Google I sold $72,000 worth of Google today. Took over $37,000 in profit. Google isn't a bad company. It's one of the greatest businesses in the world. It's not overvalued, it's fairly valued, but the easy money has already been made. My projections: bull case, 14% revenue growth, 14% net income growth, fair PE of 27.32. That gives me maybe 11-16% CAGR. Base case, 12% revenue and net income growth, PE 24.29. That's 6-11% CAGR. That's basically market level returns. I'm not interested in market level returns when I see better opportunities. I'm still holding 222 shares, but they could be gone tomorrow or next year. Google doubled for me. That was the big move. Now I want stronger upside potential. Brutal mistake, Duolingo hedge. Last summer, I bought Duolingo puts. Sold them a week later for $19,000 profit. Fast forward, those same contracts would be worth over $280,000 today. Painful. Yes, you never go broke taking profits. But you can still look back and say, wow, that's investing. 3 stocks I bought: 1. Salesforce, CRM, $42,000 purchase SaaS has been crushed. I think it's overdone. Bull case, 14% revenue growth, 22% net income growth, 29 to 34 PE, 32 to 38% CAGR. Base case, 12% revenue, 20% net income, 27.32 PE, 28, 34% CAGR. That's attractive. 2, American Express, $20,000, not really AI disrupted. Bull case, 18% revenue growth, 15% net income growth, 30 to 35 PE, mid 20% CAGR. Base case, 8% revenue, 12% net income, 28.33 PE, or 20% CAGR. One of the safest business models out there. 3, Nike, $9,700 turnaround in motion. Numbers show improvement last 2 quarters. Stock was 150 plus. I think it returns to 120, 150 over 36 months. Could I be wrong? Of course. But probability favors recovery. HimTalk collapse, stock down 62% in 6 months. Novo Nordisk is suing them. That's serious. They have cash to fight, about 345 mailers cash plus short-term investments, but legal costs could run into tens or hundreds of millions. AI legal analysis suggests Novo likely wins based on patent strength. If that happens, HIMS may pivot away from key products and potentially pay damages. The real issue? Uncertainty. You can't project revenue growth right now. You can't confidently model EPS. You don't know litigation cost. Analysts will likely lower estimates over the next several months. Add Amazon as a future competitor, too many unknowns. For me, HIMS is off the table for 2026. I'll revisit in 2027. There are too many clearer opportunities elsewhere. Final thoughts: keep buying great companies, strengthen your portfolio consistently, ignore noise, focus on quality. I'm under the weather, but I appreciate you being here. Valentine's Day sale, pinned comment. Much love. Have a great one.